we believe that we are in the 8th inning of this current secular bull market that began back in 2009, and have several reasons to support this belief. First is excess returns. This chart illustrates the 10-year annualized real returns for the S&P 500 index. Each bar represents the 10-year annualized real rate of return of that index. Again, this does not include dividends and is after inflation. Most people are not aware that the long-term average of the S&P 500 index after dividends and inflation is just 2.4%. What we have observed is when this 10-year annualized real rate of return approaches 10%, the stock market was historically nearing the end of its secular bull market. As you can see, the 3 periods we circled include the late 20s, the mid-60s, and the late 90s. We're all at the end of secular bull markets. It is important to understand that the market does not just go from a secular bull to a secular bear the first time the stock market experiences a 10-year annualized real rate of return of 10%. You can see that the market can stay elevated at these return levels for several years. So where are we today? The 10-year rolling returns are approaching 10%, and is just one reason why we believe that we are in the 8th inning of the secular bull market that started back in 2009. The second reason we believe we're in the 8th inning of the secular bull market is because of the massive amount of government spending is providing a tailwind for equities. One of the long-term concerns with this amount of spending is that at some point, the government will most likely be forced to raise taxes to pay down this debt, which could negatively impact consumer spending and corporate profits that fuel economic growth. The third reason for our belief is because the low interest rate environment continues to make equity valuations more attractive relative to bonds. The Fed reiterated their commitment to keep rates near zero until at least 2023. Now, have we seen the low? If it continues this way, this is a potential sign that we are near the end. And finally, the ownership of equities among individuals has soared. Historically, stock market returns that attract interest and optimism from average consumers should be viewed from a contrarian perspective and seen as extremely risky. For further information on how this information may impact your portfolio, please reach out to your Meeder consultant today. Meeder, with you, for you.